If I avoided these financial mistakes when I was younger, I wouldn't be in the hole that I am in now. Now that I'm in my 30s, I can see a little bit more clearly on how finances work and who the clear winners and losers are when it comes to the money game. So in this video, I want to share some lessons with you that I wish somebody would have told my younger self. Here are the 10 financial mistakes that I wish I would have avoided in my 20s. Number 1, avoid co-signing for others. When you co-sign for somebody else, you are becoming the co-owner of that person's debt. You're sharing your social security number as well as your identity for somebody else to qualify for a loan or rent something like an apartment. This is common amongst close friends, family members, and even when you're in a relationship. Now, don't get me wrong, helping somebody that you love is a noble thing. If my sister, for example, needed help to qualify for a loan to buy a house or even qualify for a place to rent, I would gladly help. But if there was a way to avoid it, like helping her fix her credit so that she could qualify on her own, I would do that 9 times out of 10. And here's why. Number 1, co-signing for somebody else will hurt your chances of getting a loan. How, you may ask? Because any and all debt found on your credit report will be factored into the bank's decision to extend you credit. Simply saying to the bank, but it's not my debt, that's my sister's debt, is not going to remove that debt from your credit reports and the underwriting process. The underwriting process that the banks put you through is the bank's way of judging you to see your ability to repay back the debt that they allow you to borrow. Number 2, their late payments are your late payments. Their collections are your collections. Remember, you are the co-owner of their debts or responsibilities. So their negative actions will also impact you as well too. So if you can, avoid co-signing at all costs. Number 2, avoid spending money that you don't have in the bank. Now, what do I mean by this? I mean that if it's not in your checking account, don't spend it on a credit card. Nowadays, it's very easy to get a credit card, especially with the information found here on YouTube. And it's even easier to spend the money without ever having a plan of action to pay it back. You see, credit card companies, they know this. Matter of fact, they spend billions of dollars per year to advertise to people just like us. So it comes at no surprise that the average credit card debt per household is $6,501 per holder. And what I know now is that every single time that you borrow money from a credit card, you're actually borrowing from your future self. And your future self will have to pay back that money. So spending money that I don't have today is actually putting me deeper into financial slavery in the future. Now, I don't know about you, but I don't personally want to be somebody else's slave. And now that I'm in my 30s and I have a wife and kids, I definitely don't want to put them under more financial stress. So here's my advice to my younger self. Only spend money that you've earned from income. And if you need to borrow money from the bank, make sure it's for a business idea that has the potential of putting money back in your pocket. Number 3, avoid spending your whole paycheck when you actually get it. Now, when I was younger, I was bold and dumb. And bold and dumb is a very dangerous combination. As soon as I would get my bi-weekly paycheck from my employer, I would drive straight to the casino. Now, poker is my game of choice. And for some odd reason, when I was younger, I thought personally that I was going to be the next World of Series poker champion. So I would take my whole paycheck and bet on myself. Now, fast forwarding 15 years, I am not a poker champion, and I think I have lost more money than I have actually won. But for some odd reason, deep down inside, I like to believe that I have broke even from my win and losses. But what I should have done is I should have saved my money, because having an emergency fund gives me so much peace of mind. I sleep so much better at night with money in the bank, and now I get to actually spend quality time with my kids as opposed to worrying about finances. So set yourself up for success, not failure, and set a certain percentage aside of your paycheck so that you could have an emergency fund and sleep better at night too. Number 4, avoid carrying high balances on credit cards. Now, carrying high balances on credit cards will affect your credit to utilization ratio. Credit utilization is how much credit that you have spent in relation to your credit limit, and this is also known as your debt to credit limit ratio. In the bank's eyes, carrying over 30% utilization is considered high. And if you want to maintain a high credit score, it is best practice to keep your credit utilization lower than 10%. Credit utilization makes up a third of our overall credit score. So it is best to keep your credit card balances low so that the bank doesn't view you as a high risk borrower. Here's a tip. Pay down your credit card balances right before your statement closing date. By doing so, the banks will report a low balance to the 3 credit reporting agencies, Experian, TransUnion, and Equifax. Because banks typically share information once per month to the big 3 reporting agencies. And the information that they share is your actual bank statement with the overall balance, your credit card limit, and so much more. So there's a window of opportunity to hack the system if done right. Number 5, not knowing how to calculate APR on credit cards and loans. So this is something that you should definitely know and understand. APR stands for annual percentage rate, and this is the rate at which the banks will charge you for borrowing their money. Here's an example. Let's just say if I borrow $20,000 $20,000 from the bank and they charge me 20% on an annual basis. $20,000 times 20% equals $4,000. This is how much interest I would pay per year. If we divide that by 12, 4,000 divided by 12 equals $333.33. And this is how much interest I would pay per month if I carried a balance of $20,000 at a rate of 20% APR. Now, typically on loans, your interest rate is not going to go up or down. It's going to stay the same. However, on credit cards, your interest rate will fluctuate up and down depending on the market. So here's why paying the minimum balance on your credit cards is a bad idea. So how the minimum payment is calculated on credit cards is they'll take the overall interest that you owe that particular month from the amount that you borrowed, and they're going to add that interest payment to 1% of the overall money that you borrowed from that bank. So let's just stick with the example that I just used. So if I borrowed $20,000 from the bank and they're going to charge me 20% interest, my monthly interest payments are going to be $333.33 if the balance is not lower every single month. Now, 1% of the overall money that I borrowed, which is $20,000, is going to be $200. 20,000 times 1% equals $200. So if I take the interest payment of $333 plus the 1% of the overall balance, which is $200, $333 plus $200 is $533 per month, and that is going to be the minimum monthly payment. So if I just paid the minimum payment on this credit card, it would take me 415 months to get rid of my debt. In that time, I will pay $32,723.48 in interest alone. So the real cost of borrowing $20,000 at a rate of 20% isn't actually 20%. It's over 100% because the interest alone is going to be over $32,000 if I pay the minimum payment every single month. Do you see where I'm going with this, or did I lose you? The point is to know what you're getting yourself into and also knowing how to do the math when you decide to borrow money from the bank. I don't know, or I don't know how can only be used once. So if you just use your I don't know how to calculate the minimum payments on my credit cards, do me a favor and subscribe to the channel, because what I'm going to do is I'm going to drop the link in below of a credit card calculator that I love to use that helps me calculate these numbers that I just shown you here on this specific point. Number 6, avoid bold claims and shiny toys. Now, what I'm referring to here is going to be get rich quick schemes. Now, the idea of getting rich quick sounds better than getting rich slow, and money now always sounds better than money later. But for me to you, this is a fair warning. Most people will tell you whatever it is that you want to hear in an attempt to extract your money out of your pocket, leaving you confused and dumbfounded when you don't get anything in return. I have personally fallen for many get rich quick schemes in my life, and they have all set me back financially. So a word to the wise and advice from my older self to my younger self, or your younger self, is avoid people with shiny toys like cars, boats, trains, and planes with bold claims and promises to your next riches. I personally believe that the only way to financial abundance, aka financial wealth, is through financial literacy. So do me a favor and like the video and show some love. Number 7 is going to be not buying real estate sooner. Now, real estate is a simple concept. Provide shelter in exchange for compensation. Not only is real estate an asset that can provide cash flow, it can also grow in value, also known as appreciation. The overwhelming majority of people who bought real estate 10, 20, and 30 years ago is better off with that real estate and with that asset in their back pocket as opposed to not. Now, the cool thing about real estate is that you could always extract the equity for tax-free money now. And it's also something that you could pass down to your kids or your spouse when you pass away, creating generational wealth. All right. We got to speed this up a little bit because I have somewhere to be. Number 8 is going to be avoiding doing too many things at one time. Multiple streams of income is a hot buzzword right now. One income source is lame, but multiple is cool. However, here's the problem. When it comes to borrowing money from the banks like to see stability. And if you have a whole bunch of 1099s from different employers, the banks might not take you as seriously if you had one stable income for a long duration of time. It's much better to focus on one thing, stabilize that, and then move on to the next. Now, there's never just one way to do anything, so take what I say with a grain of salt. If you're okay with doing what you're doing, that's all that matters. However, if you're looking for change like I was in my 20s, I would tell my younger self to stick to one thing and never stop believing in yourself. Now, this is a perfect segue into number 9. Number 9 is not investing into myself sooner. I'm talking about books, seminars, groups, even my health and learning a new trade. Personal development is the way out to anything. You are your own greatest asset. So each and every one of us should invest into ourselves themselves more. What good is having $1 million if you can't enjoy it because of poor health? Or what good is starting a business if your employees are not inspired to follow your lead? Personal development sharpens your mind, helps you better interact with other people, and better prepares you for overall life. The greatest investment is always going to be yourself. So don't skip another day without financially investing into yourself. All right, last but not least, number 10, avoid negatives at all costs. Always pay debt back and on time, because borrowing money from the bank is building a relationship with the bank. Avoid late payments, charge-offs, collections, and bankruptcies. Now, if you have fallen behind on your bills, I would strongly consider that you call the bank and let them know that you have fallen on hard times, and if they are willing to work with you to pay back the money that you owe. And if you have fallen victim to late payments, collections, or charge-offs, and they're actually reporting on your credit report, I would strongly encourage you to look into credit repair. Credit repair is the practice of disputing the accuracy of information furnished on your credit report and deletion of negative accounts if consumer law is violated by credit reporting agencies. Don't lose hope, keep your head up, and find a way to bounce back from negatives or avoid them entirely. All right. Those are my top 10 tips. I hope you enjoyed it, and do me a favor, learn from my mistakes so that you could pave a better future for yourself as well as the people that you love. Do me a favor and like the video, subscribe to the channel, and if you have fallen victim to any of these financial mistakes, let us know in the comment section below. Have a great day, be the best version of you, and do me a favor and share this video with someone who needs it the most. Thank you so much for watching this video, and I'll catch you on the next one.